Welcome to Phillip Futures webinar. My name is Zhen Sheng, and today we'll be going through the performance of gold, the reasons for the strong increase in the price of gold, the investment rationale for gold, and the outlook of gold prices. For this webinar, we'll be looking at briefly at the history of gold, a fundamental and technical analysis of gold, gold prices outlook, investment basis, and how you can gain exposure to gold. Historically, gold serves as a form of currency for people to exchange for goods. Gold standard was actually introduced to allow people to link the currencies to the portion of gold. Gold was linked to the supply of money, and fiat currencies can be converted for gold. However, the gold standard was subsequently abandoned because of its lack of international coordination and the economic instability it actually created. Currently, gold serves as a form of reserve in central banks, and the return back to gold standard seems impractical given current central bank monetary policies. Briefly, at the fundamental analysis overview, gold price has risen due to the demand for safe haven asset, strong demand by central banks, depressed rates and deflation concern, and mixed US dollar strength. We will examine each of these reasons in detail. So on to the gold safe haven status. Although some market stress and anxiety have already subsided since the Brexit aftermath, gold prices has already rose strongly previously from the Brexit situation. Gold is seen as a safe haven status, and investors invest in gold as a hedge against market stress. The strong demand for gold could be seen as a reflection of the increasing anxiety over the global economic poor outlook. Gold is perceived to be a safe haven status as it has shown that in time of crisis, it is able to preserve its value, and its value can even rise in this situation. It also demonstrated that it is liquid in time of crisis, and investors can readily liquidate their gold investment holdings if there's a need. Central banks are currently strongly buying into gold, particularly Russia and China. This is seen as a means of them to diversify away from the US dollar assets into other form of reserve. In lieu of the current uncertain economic climate, gold is seen as a form of good safe haven status asset that the central banks can rely on. Central banks have stock up on these gold holdings to protect against any form of economic crisis if such situation were to occur. As gold has shown that it can be able to preserve its value even in time of crisis. Central banks are currently embarking on quantitative easing program or bias towards cutting interest rates. Due to this depressed interest rate environment and deflationary concerns, that means that the treasury yields offer lacklustrous return. In addition, gold, when financed by borrowing, would mean that the opportunity cost of holding it would be low in this low interest rates environment. So, investors who want to invest into gold would be a good opportunity for you to invest into it now to take opportunity of the low opportunity cost. US Federal Reserve has been slow in raising its interest rates, and gold is priced in US dollar. Thus, this means that there's an inverse relationship between gold and US dollar. When the US dollar appreciates, gold prices will fall, vice versa. The reason for this relationship is because when US dollar weakens, it means that the purchasing power of the US dollar has actually weakened, and thus other currencies are actually strengthening against US dollar, and non-US dollar region would find it cheaper to buy gold. In addition, US dollar is seen as a store of value on its international reserve status. On a weakening US dollar, other investors will be concerned with this weakening US dollar and may prefer to hold gold as a form of reserve. Now, this also causes the increase in gold prices when the US dollar weakens. Thus, this actually drives up the price of gold in the current mixed US dollar strength. Based on the gold weekly chart, we can see that gold prices has broken out from a multi-year channel. okay, and it has rose sharply in 2016. In addition, gold prices has also broken from its 50-day moving average, 100-day moving average, and 200-day moving average, and is trading near its high. From the Fibonacci retracement, we can see that currently gold is actually testing the 38.2% retracement level. Gold has already rose significantly for this year, and based on the relative strength index, it's actually close to overbought with a RSI reading of 61.09. In addition, the immediate resistance level are 1433.73, 1392.33, and 1375.34. While the immediate support levels are 1305.60, 1250.89, and 1199.80. Gold prices are currently on a strong uptrend and is forming higher high and higher low, and are trading above the moving averages. Going forward, if the momentum were to persist, gold may possibly go higher in the long term. Generally, gold prices has rose significantly for this year already. The easy money on buying gold has already been made. On a technical analysis perspective, gold has already broken off its 50 moving average, 100 moving average, and 200 moving average technical analysis. 1400 will pose to be a significant resistance for gold prices to break through, and there are some signs that it is close to being overbought at the current moment. Gold prices probably will consolidate at this current price level of around 1350, or it may slightly retrace in the coming months. On a fundamental analysis perspective, gold prices may face headwinds in the coming months as US Federal Reserve may be inclined to raise interest rates towards the end of this year. However, we expect gold prices to be supported on central banks' demand for gold, and also on the poor economic outlook and the lingering uncertainty of the Eurozone stability. The investment rationale of gold is that it provides a form of diversification and liquidity in times of crisis and acts as a safeguard against market turmoil. Gold has low or even negative correlation with other asset classes. When you invest gold and include it into your investment portfolio, it will ensure that you will not lose money on all of your investment vehicles simultaneously on all fronts should any situation occur. This ensures a more stable performance over time for your investment portfolio. Secondly, gold provides a readily stable liquidity as its worth is internationally recognized by investors. You can readily liquidate gold, for example, maybe over-the-counter spot gold derivative through brokerage houses. In addition, in times of economic crisis, gold can actually be able to preserve its value and even increase. The reason being for that is due to capital flight to safety, as investors will actually withdraw their money from riskier asset equities and divert funds to safe haven asset status such as gold. Investors that are considering gaining exposure to gold can consider physical bullions, over-the-counter spot gold, and gold futures. For physical bullions, they come in various weights and numismatic prints. However, for physical bullion, there are insurance and storage concerns, which may be a hassle for investors. Phillip futures offer over-the-counter spot gold, which gold investors can really consider including into their portfolio. In addition, Phillip futures offer also the gold futures that is centrally traded on an exchange, such as the Chicago Mercantile Exchange and Tokyo Commodities Exchange. As for promotion, Phillip Futures Singapore is currently running a trade gold for gold promotion. Investors who trade over-the-counter spot gold stands to receive up to 5 grams of premium gold. For more details, you can head down to www.phillipfutures.com.sg. If you have a Phillip Futures office in your country of your residence, you may wish to check in with the office for more details on their ongoing promotions. This wraps up our Go webinar for today. Please do look out for our Futures Go webinar. Thank you.